This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
This is episode 261, and even though it's a weekly reality check, our reality is that we don't record every week, and we do that in bursts, and some weeks are busy, some weeks are not, and we've actually just had a 3-week hiatus from recording, and boy, came out rusty. I don't know about you, Ben, but just the mechanics behind it when you kind of get out of sync, because we recorded a lot before you took a bit of a vacation. But now we're back, and you had 2 fantastic finds for today's episode. Maybe you want to cue that up.
Yeah, sure. I mean, it all kind of stems from I did a Twitter thread. We'll introduce this more when we get to that section. But there was a Twitter thread that I did on structured products, and wrote an article on it. We did an episode on it. And it was just an interesting topic to cover. But when I did that Twitter thread, a couple of the people whose papers I had referenced jumped into the thread and were kind of participating in the discussion. I thought that was pretty cool. So I asked both of them if they would come on the podcast to talk about the research, which they both agreed to. So that was Felix Fattinger and Petra Vokata.
And then we also welcome back to this episode Jill Schlesinger. She recently released her book, The Great Money Reset, which is a fascinating book, and it's a situation that applies to lots of people. So I had a great conversation with her, and then also do a quick review of her episode when she was on episode 67 back in 2019, if you can believe it. And then at the end in the Aftershow, for those who are interested, you'll actually hear an original song about a conversation Ben and I had on another podcast. So we'll play it at the end.
Yep. Sounds good. There was a Reddit thread that I saw today where someone who listens to the podcast and likes PWL and likes us wanted to go and look for a financial advisor, but they weren't going to get in touch with us because of our $1 million minimum.
Oh, no.
So I jumped in and clarified that we've eliminated our minimum, which of course we've mentioned on the podcast a couple of times, but clearly that message has not gotten out there as far as it needs to. So to reiterate, we no longer have an investable asset minimum. We did for a long time. We no longer do. We are still assessing client fit, but we're doing it case by case. And it's that singular criteria of you have to have X amount of assets to talk to us. That's no longer there. So if anyone's thinking about hiring a financial advisor or making a change to a new one, my suggestion is that you get in touch through our website, talk to one of our financial planners, and they'll tell you if they think it could be a fit, or if not, they'll point you in the right direction for other options. And Cameron and I are also available to have those conversations if that's helpful. We've got a couple of upcoming events. We're hosting a Women in Wealth Conversation Circle on July 20th. It's a Zoom event. There's only 9 spots available for that one. The last ones of these that we've run have gotten really, really good feedback. You can
Indeed.
sign up to that through the PWO website. And we've also got a webinar on finding and funding a good life presented by one of our financial planners on July 26th, which you can also sign up for on our website.
Awesome. With that, let's get to the episode. Okay, welcome to episode 261.
All right, so slightly repetitive because I said this in the introduction. We covered structured products recently in an episode that started as a Twitter thread that I just kind of did on a whim. I think I read a paper and I was like, oh, this is really interesting. And then decided to find if there were more papers, and I found a handful of them, so I made a Twitter thread. Whatever, no big deal. But a lot of people liked it and engaged with it. And a couple of the authors of the papers that I had linked to jumped into the conversation, added some context. One of them gave me an updated version of their paper. And actually one of them had, Petra Vokata had a second paper on that topic. So that was all cool. So we thought it'd be interesting, since this is a really nuanced topic, to have them on for an episode, kind of like what we did with Paul Caluso after we talked about covered calls. So we've got these two guest segments. Both of them have really cool papers on structured products, on yield enhancement products specifically, which, as it turns out, are products that behave somewhat like covered calls. So it's a specific type of structured product, which we get into in our conversations with them. The two guests are Felix Fattinger, who's assistant professor of finance at VU Vienna and the Vienna Graduate School of Finance. He has a research interest in complexity, both at the aggregate market level and from a retail investor's perspective. And then the other guest that we have is Petra Vokata. She is an assistant professor of finance at Ohio State University with research interests including household finance, financial innovation, and consumer financial protection. So we'll go ahead to our conversation with Felix Fattinger first. And after that, we'll follow up with our conversation with Petra Vokata. Felix Fattinger, welcome to the Rational Reminder podcast.
Hi, Ben. Thanks for having me.
Felix, what makes you interested in complexity from the retail investor's perspective as an area of research?
Well, I think it's fair to say that complexity is ubiquitous to real-world decision-making, and in financial markets in particular, right? So we have investors who are constantly updating their beliefs based on an expanding set of information. And I think in this context, at least two things are interesting about retail investors. So first, when you think about it, they kind of represent the ultimate investor base, right? Eventually, all the capital that's invested is owned by retail investors. And second, when you compare them to kind of the other participants in the market, so the intermediaries, the institution, the professional investors, there naturally arise information asymmetries because these institutional investors, they have access to a usually different subset of information that's not available to retail investors. They have access to additional technology and resources, which allows them in certain cases to update their beliefs differently. So this kind of creates naturally these information asymmetries, which come because there are these complexities. The problems are so complex. And I think this is super fascinating. And if you then in particular think about retail investment products, I think it's just super interesting to think about, okay, in this setting, because we usually have the demand side that tries to invest in these products. So the retail investors say they usually have inferior information, and we have the sell side that provides these products, hopefully in the best interest of the retail investors. But because of these information asymmetries that arise, because of these very different levels of complexity we have and different types of complexities, so we'll talk about a very specific one today. I think it's just a very fascinating topic and kind of to study how the level of complexity also changes endogenously over time is super fascinating, I think.
Yeah, it is interesting, but it's also super important for retail investors to understand because of the asymmetries that you're just talking about.
And essentially, because they are the ultimate investor base, their decisions really matter, right? In the aggregate, what they do is important for society at large. So I think that's what's important point we forget.
Yeah. So the paper that we're talking about focuses on yield enhancement products or YEPs. What are those?
Okay, so YEPs. So in the most basic way, you can think of them as consisting of two components. So usually they have a fixed coupon, which is guaranteed by the issuer. So you will get it no matter what. Like the only case you won't get it is if the issuer actually defaults. And the second component is the part that actually finances this coupon. So it's an exposure to downside risk that comes from an underlying. So think of an underlying stock. Now, let me be a bit more precise and actually make an example. So think of the following product. You can invest, let's say, $1,000 for 1 year, and you get a coupon of 10%. So it's really a sizable coupon, $100, which is guaranteed after the end of the year. Now, the product is on an equity, let's say Microsoft. Now, the way this works is if the Microsoft share price kind of remains stable or even rises over this 1 year, you will actually get at the end of the year your notional investment back in full. So you will get 1,000 plus 100, 1,100, 10% return. So that sounds pretty good. Now, the other case is essentially if the Microsoft stock price falls significantly. So let's assume over the year it falls by 30%. Now, in that case, you start participating in the losses, which means like you will lose 30% on your notional, meaning that you will get back 2 shares of Microsoft. So roughly speaking, that's 700 worth of Microsoft shares. So last share price is kind of close to 350. So that's roughly 2 Microsoft shares. And the coupon you always get back. So you will get 800 back, which is a loss of 20% on your investment. This is kind of how they work. Like some of them also have a security buffer, which means that you only start participating in the losses if the underlying falls at least by, let's say, 25%. And if you want to have it really the technical definition, essentially what it is, it's a fixed coupon bond together with a short put option on one underlying, like in the example I just mentioned, or as we will get to later, could also be several underlyings, so several underlying stocks.
Do you think your findings generalize to other types of structured products?
That's a good question. So what we do in this paper, we focus on the European market, in particular on Switzerland, which is, I think, an interesting market. It's kind of, you can consider it as the birthplace of structured products. They have been around since the early 90s. And in Europe, what's interesting is the products are more standardized than in North America. So when you talk about investment products, they're usually, so both the industry and the regulators, they're distinguished between three types. So you have yield enhancement, right? You have also capital protection and participation. Capital protection is less risky because there usually your investment is protected, but on the other hand, your upside is very limited. So you only participate in a limited amount if the underlying goes up. On the other hand, you have participation, which is the more riskier version than yield enhancing products. There you actually participate more than 1-to-1, but you have no kind of security buffer whatsoever, so they are riskier. Now, what is interesting is that these yield enhancing products which we study are the ones that have been growing the most during this period of low interest rates we've seen recently. So across the major European markets, the outstanding volume amounted to roughly, or a bit more than 110 billion euros in the first quarter of 2023. Now, in the US or in North America, it's harder to get aggregate data, but kind of what recent evidence suggests is that also there, these yield enhancing products have been the most important and fastest growing product type among structured investment products. Now, when it comes to our finding of how low interest rates have created demand for yield enhancing products in particular, this is probably specific to this very type of structured product. However, when we talk about the other aspect of our paper, kind of the rising level of complexity, I think this, or I believe, is generalizable to the other types of structured products as well. Yes.
I was just thinking when you described the payoff profile. So there's the fixed coupon bond plus a short put. Does that end up being kind of like a covered call payoff?
Well, a covered call is right. You have the underlying and you write a call option. So in a sense, it's similar-ish, right? In the sense that if the upside is really big, you won't participate, right? Because then the buyer of the call will just get the underlying. And you're also exposed to the underlying risk. So in that sense, when you think about the payoff structure, there are definitely similarities. Because in a sense, what you're promised, right, with the yield enhancing product is this coupon. And with a covered call, it's similar because essentially what you lock in is the premium of the option, right, which you can't lose. But essentially, you're giving up a huge part of the upside. So I think the overall structures are definitely comparable. Yes.
Yeah, interesting. And you still have the downside exposure because that's we talked about covered calls recently on in another episode. But we've seen a ton of recent interest in those as well, and it's probably for similar reasons, like just the yield enhancement idea.
This idea that you get like this fixed income, which is usually quite sizable, right? And then you hope that things don't go bad. But I think probably different, like with these yield enhancement products that we see in Europe, they have this security buffer, right? So you only kind of start participating if the losses are really substantial, which is a twist that issuers have used to kind of argue, well, look, they're fairly riskless, right? Because things have to go really bad until you start participating in these losses.
Yeah, that's interesting. But you probably pay for that in the cost of the product.
Yeah, well, I guess we'll get to the markups in a few moments.
In the research, how do you measure complexity?
Okay, so that's a very good question. And obviously, you can try to come up with different measures. So what we do, we essentially take a look at what has happened in the market that we study, and we see a very strong shift from products or YEPs that have been issued, which are just on one underlying stock. So think of Microsoft, to a world where most of these YEPs, so think 80% or more, are actually issued on multiple securities. Now, this is where it gets tricky. So the way it works with multiple securities, it's a worst of payoff structure. So the one underlying that becomes payoff relevant will be the one like just by security design, that has performed the worst. Right? So it's the opposite of what we usually think of when we talk about diversification. The more underlyings you have, the riskier it becomes. So when you think about this more technically, this essentially means that with each underlying you add, you have an additional layer or an additional potential payoff dependency, right? So it could be a different product, which could potentially become payoff relevant. So what happens, the number of contingencies in the security design increases. So what we do is we just simply count the number of underlyings, and we argue the more underlyings a YEP has, the more complex it becomes. Because when you think about it from the investor's perspective, what they have to do is they not only have to assess kind of the future evolution of one stock, of Microsoft, but let's say also, I don't know, Apple or Meta or Netflix or whatever. And also, don't forget, they have to think about the correlations, all the pairwise correlations, which make it much harder to evaluate these products. So essentially, the way you have to think about our measure of complexity, the more underlyings, the more complex it gets.
Interesting. How did the low interest rate environment following the financial crisis, say between 2008 and 2017, how did that affect the YEP market?
So I think in this regard, the YEP product type is a particularly interesting one in this space of structured products. So as already mentioned, right? So they have this coupon which is guaranteed, and they are actually, so it's called the headline rate. And usually, like when you see the prospectus of such a product, it's literally the headline, and it's kind of in bold face. Then you have these annual coupons, which can be really sizable. So think of 10, 15, or even 20%. So much more than the risk-free rate. Now, what has happened is that you've seen issuers that kind of made this pitch to investors. Look, if we're now in an environment where kind of what you earn on your fixed income instrument has gone down, and down, what you might be interested in something that is also relatively risk-free, right? So you have the security buffer, but still gives you this fixed income, which you kind of can count on. And this directly speaks to this phenomenon that's called reaching for yield among retail investors, right? So this willingness that has been documented in different studies, that if the interest rate environment is low, what happens is that retail investors have this tendency to increase their willingness to accept additional risk. I think this is kind of what we argue in the paper, one of the reasons why the outstanding volume of these products in Europe has really risen quite sharply during this period, following the global financial crisis and the low interest rate environment afterwards.
Can you talk more about, because you've looked at the data on this, on how investor demand for YEPs does change with decreasing rates?
Yes. So now this is not as straightforward as you might think, right? So if you just look at the empirical data, what you can see, there was a consistent rise in the outstanding volume of the product of the market we studied during this time period. And you can also do this a bit more sophisticated. So what you can do, like empirically, you can take all the instances where there was an unexpected drop in the interest rate, and you can kind of try to test in a clean way whether this has led to an increase in the volume. And this is what we find. But in order to pin this down more precisely, what we do, one part of the paper, we run an experiment, because in order to really pin this down cleanly, you have to make sure that the endogeneity problem is kind of out of the picture. We know low interest rates, they're not adjusted randomly, right? So central bankers usually lower interest rates or rise interest rates depending on their forward-looking assessment of the economy. Right? And this will also interact with the demand and supply of these products. So to do this in a clean way, we just run a simple experiment. And in a nutshell, what we find is indeed, yes, what we kind of expected. If interest rates go down, if they approach the zero lower bound, or even are slightly below, which they have been for quite some time in many European countries, then indeed there is an increase in demand for these yield-enhancing products. Now, what's important is that this increase in demand, both empirically as well as experimentally, increases in similar magnitude for all these yield-enhancing products. So it doesn't make a difference whether you talk less complex or more complex. And again, here the intuition is that this coupon, this headline rate, which is already offered, which is usually lower for the less complex product, but this is efficient to kind of make this substitution, right? Because already these lower coupons are like in the realm of, let's say, 10 or 12% on an annualized basis. So in a summary, nutshell, it seems that the low interest rate environment has really spurred the demand for these kind of products, but it does not, at least not directly, explain why we have seen a rise in complexity in this segment.
Yeah, that's it. And we're going to dig more into the complexity piece, the change in complexity in a second. But I just want to on headline rates. You mentioned that a couple of times. Can you just briefly expand on what a headline rate is, and also if there is a relationship between expected returns and headline rates?
Yes. Okay. So the headline rate is really like this coupon, which is guaranteed if you invest in the product. So it would be, in the example before, like the 10% you get if you invest in 1 year for this kind of product. And 1 year is kind of the typical maturity that we see across the products that we have studied. Now, in terms of expected return, right? So essentially, it is the conditional expected return which you get in the good case scenario, right? If nothing goes bad, you will get your notional back at the end of the lifetime of the product. So let's say the $1,000 we assumed before plus the coupon, right? So essentially, in that case, in the most simple scenario, if you abstract any additional costs and fees, this will be your return. And in Europe, it turns out that these coupons, these headline rates, are already net of return, net of fees. So essentially, the distribution, the hedging costs, etc., they are already deducted, and kind of the coupon, the headline rate, which investors see, is literally what they get in case the good case scenario plays out. However, right, if we fall below the security buffer, if this short put option actually is activated, well, then obviously returns can be quite different. So in order to compute expected returns, you also have to include the potential downside risk, which you are encountering when you invest in these products.
Yeah, it's so tricky where the headline return is kind of the best case return. But if
exactly. And it's very salient as well, right? Like if you think about an investor, it's hard if you think about a product that has multiple underlyings. So how likely is it that one of them will lose, let's say, 25 or even 30%? And in that case, what will be its value, right? Conditional on hitting that barrier. On the other hand, you just have this fixed coupon, which is guaranteed no matter what, right? And it just makes it very salient, very simple to kind of use this just as a benchmark. And I think that's kind of one of the problems that you have this very salient piece, and kind of to understand the full picture, it's much hard to make the actual evaluation. And what you have to do if you want to get at the actual markup, so the true expected return, you will have to rely on option pricing theory, right, to estimate this embedded short put option in order to really get to the true markup, or in other words, the expected return.
Yeah.
Wow. How does product complexity change with growth in the market for YEPs?
Yeah, so this is now where it gets interesting. So remember, right? We think that we demonstrate or we provide evidence that interest rates have increased the demand, but they do not at least directly explain why complexities would change. Now, coming back to what I mentioned before, what we see quite clearly is that there is this shift from YEPs on one underlying to YEPs on multiple underlyings. So complexity goes up, right? Now, just to be a bit more precise, what essentially happens, we go from a world where less than half of the products have multiple underlyings to a world at the end of our sample period where 80% or even more of these products have multiple underlyings. And kind of the median product that you see uses 3 underlyings with this worst of payoff structure. So there is this increase in the complexity that we can clearly see. And what's also interesting, when you go to the US, so what we did very recently, we tried to get data for the US as well, which is a bit more tricky, but a very interesting phenomenon has happened there as well. So you had these yield enhancing products a couple of years ago, which were mostly on just one underlying security. And in the last 1 or 2 years, 50% or close to 50% now are also multiple underlying securities. So it kind of seems that the US market or the North American market is kind of headed towards a similar direction compared to what we have been seeing in Europe now for a couple of years.
Really, really interesting.
Mm-hmm.
But how do issuer margins vary with complexity?
Yeah, so I think it's an important question to also kind of start thinking about more systematically how complexity evolves over time. So what do we do, right? Is kind of a natural thing to do is we estimate these markups. Now, what you have to do is you have to kind of the fixed coupon bond is easy to evaluate, right? So you can account for the credit risk of the issuers, but when you just compare less versus more complex, this just cancels out because they're usually issued by the same issuers. So what's really the tricky bit is this embedded put option, in particular if it's a basket put option on these several underlyings. So what we do is we essentially use option pricing theory and get to these markups. And I mean, probably you've expected it. What we find is that the markups for more complex products are substantially higher. So on average, we find markups of around 5% for what we call these multi-products, right? So these are the YEPs on multiple underlines, and around 2% annualized for the products on just one underlying. So there is a substantial difference. And what's also important in this context to keep in mind that because of dynamic hedging, the issuers, they can lock in essentially at the time of issuance a substantial part of this markup. Not everything, right? There might be additional hedging costs, etc., which are not yet part of the coupon reduction that they've already applied for the headline rate. But still, kind of our understanding is that a big portion they can lock in at the issuance, and they just hedge all the dynamic evaluation of the value of the product over its lifetime. And if you kind of follow this reasoning, you could argue that this is kind of an interesting way to get very cheap funding for these banks that issue these products.
Interesting. So complexity is pretty good business for the issuing institutions.
In this particular market, the YEPs market, yes, definitely so.
How does complexity vary with the efficiency of the issuer?
Yeah, so I think now this allows me to kind of complete the picture. So what's interesting is if you look at these markups over time, and you start with the simpler, the single market segment, right? Just one underlying asset, you see very robustly that markups actually go down over time. Which speaks, this is in the interest of the investor, right? So if markups are lower, this just means there is more to be earned by the investors. So we see that they go down. And when we then look at who is actually active in that market, by the end of our sample, it's just a very small number of banks. And if you then dig even deeper and you look, okay, who are these banks? These are actually the banks that have the lowest markups. And these are the banks whose markups decrease the most over our sample period. So the way we interpret this is, well, what happens in this more competitive market, only the efficient issuers, banks, decide to stay to really serve that market segment, because only for them it's still profitable to do so. And we see competition in this market segment at least, right? And that's also kind of intuitive, because if you have just one underlying, it's fairly easy to compare products from different issuers. They just need to have the same one underlying. And this is kind of why we think we see decreasing margins, decreasing markups, and only the efficient ones who are deciding to stay in that segment. Now, in contrast, on the other side, if you focus on the segment of these multi-YEPs, so the ones that usually have three underlyings, the picture is very, very different. So there, all of the issuers remain more or less active, actually quite active over our entire sample period. And if you look at the markups, they don't move as much. Maybe they decrease a little bit, but depending on the specification, this trend is not statistically significant. So they seem to be much stickier and much, much more stable in this higher region. Now, how could that be? So, well, we think this actually is a symptom of competition that is mitigated, or in certain cases completely bypassed, because they are actually issuing these more complex products. So let me explain what we mean by that. We know retail investors only or like to invest in underlying stocks which they know, right? So they don't like to invest in something they've never heard of. So for instance, to make it more precise, think of the S&P 500. So all S&P 500 member stocks, right? So you have 500 stocks to choose from when you structure your multi-YEP with three underlines. So for the structurer, so the issuer, this means you have, for any given product, potentially 500 times 499 times 498 underlines to choose from. Now, this gives you 124,251,000 possible combinations, right? So you can restructure your underlyings in a way which you just replace one. So let's say you have Microsoft, Apple, and Meta, and then you just kick out Meta and you include Netflix, for instance. Then this already gives you a new product, and you don't have this one-to-one comparability anymore. And we also find evidence for this at the product level, that in this case, actually, this direct price competition decreases. And we think this is the reason why these less efficient banks, well, all the banks, but in particular the less efficient banks, they issue these multis to really dodge competition. And what's in line with this hypothesis is what we see. The underlyings that are used both for singles and multis are very similar, and they change very slowly over time. However, as the number of multis that are issued increases, so does the variety of combinations. So essentially, once the market for these multis starts to skyrocket, what you see is what they're actually doing, they're just using different combinations of underlyings.
Why do you think investors are willing to pay for the more complex products if we know they're getting hosed by a 5% or whatever margin?
Well, it's a very good question. So again, here, what helps us is the experiment, because with the experiment, we can observe all the parameters, right? So we just let subjects, we elicit their willingness to pay essentially for different products of different levels of complexity. And what we find quite clearly, the reason why it's possible to extract these higher markups for more complex products is because at least our finance students with whom we run these experiments, they underestimate the degree how much more risk you're actually taking when you move from a yield enhancement product with one underlying to a yield enhancement product with two or three underlyings. So they're not just stupid. They do understand the direction. So they do understand the more underlyings you have, the riskier it gets. But they are not fully capable to estimate how much more risky it actually gets. And to be fair, this is also a really hard problem, right? The way we can answer this is using numerical option pricing techniques in order to get to the heart of this. But kind of to ask the average retail investor to make this accurate, this assessment accurately, I think is a very high ask.
How do the YEPs in your sample generally perform?
Now, before we get to the actual numbers, I think what's super important for these products is to always keep in mind, more often than not, it actually turns out in the favor of the investor, meaning that they actually get back the notional and the coupon. This is just simply by the fact that the underlying has to lose quite a bit before you start participating in this in the downside, and the coupon is guaranteed anyhow. However, so it's rare, or relatively speaking, in a fewer cases, you actually start participating in the losses. And if you do, they're usually substantial. So just to give you an idea, if we look at the year of 2014, which is outside of the global financial crisis, the most extreme in our sample, we find that the average ex post performance of these single YEPs is -7% and -19% for these multi-YEPs. So what you can lose is really a lot, and this is despite or including these huge coupons, which can be like 10, 15, or even 20% for the multi-YEPs.
So you said they have good outcomes on average, but when you lose a lot. Is that?
Yeah. So on average it's negative. So let me be even more precise. When we look at the ex post performance over our whole sample period, they're very much aligned. I mean, there should be with our markup estimations, right? So usually kind of what the issuers make should be more or less what the investors lose, right? So it's a zero-sum game in that sense. And this is also what we find. So roughly speaking, because with ex post, you just get a few number of scenarios that eventually play out. But what we find is on average, our investors lose 1% when they invest in single YEPs, and they lose 4% when they invest in multis. So here again, it's like with increasing complexity, the ex post performance is also lower, which is of course in line with higher ex ante markups for these more complex YEPs.
Yeah, okay,
but
interesting.
To come back to your question, so if you just kind of rank all the outcomes and you just count them, more often than not, you actually get your notional back in full plus the coupon. But if you start participating in the downside, you're usually in a scenario where you lose a lot. So these losses are big enough so to make sure that actually on average, overall, you're losing money investing in these products, and you lose more on average, again, when you invest in the multi-yield enhancement products.
Oh, okay. So we've got like a negatively skewed distribution, which again is kind of similar to covered calls.
Yes, which is kind of what you would expect, I guess, to a certain extent when you look at the payoff profile, right? It's kind of capped, and the downside eventually can just go to all the way to zero plus the coupon, which obviously you will get in any case, and as long as the issuer does not default.
Yeah. Okay. Interesting. When you reflect on this paper and on your research on this topic, what do you think the main lessons for retail investors are?
Yeah, so that's always kind of the interesting question, right? So policy implications. How should we go from here? So one thing which is super interesting, again, in Europe, I think it's also true in the US, but kind of to a lesser extent. So the structured product market, relatively speaking, just has been smaller in the US than in Europe, particularly in some countries in Europe, such as Switzerland and Germany. So in a sense, what has happened, and I think this is a very interesting phenomenon, you have seen these online best execution platforms where brokers can essentially get access to and get a quote for a particular product. And you have many of these issuers that are linked to these platforms, and they compete like directly in terms of the coupon which they offer. So you have essentially perfect competition, perfect price competition. And kind of other research that we're doing indicates that once you go to these platforms, the increase in the coupon, so the improvement in the conditions, in the price you get, are really substantial. However, we would argue that as long as all retail investors don't have readily access to these platforms, competition won't play out like to the degree it should, so that it can actually be to the benefit of investors. So what we think, if there is any kind of regulation, it should go into direction to make sure that this competition can really play out, and that you kind of make it harder, that by just using strategic obfuscation, you can dodge or completely bypass competition if you choose to do so as an issuer. Another thing, obviously, you can always talk about is investor education, right? You can, as a regulator, you can try to enforce issuers to educate their investor on the risk they're actually taking. But I think this has to be done very carefully, because there's many evidence out there that if there's a regulation which is well intended just to make sure investors do understand better in what they invest in, well, issuers can work around this, right? So you come up with another socially costly obfuscation strategy to kind of get around this. However, what I think would be helpful, kind of leveraging this standardization, which we've already seen in Europe, which definitely will also be a good thing in the US, I guess, to kind of provide investors with really long-term average performances, like across all the products within a given type. Now, if you would do this for these YEPs, then investors would really see, okay, in certain years, kind of the average product really has lost a lot. And this might kind of help them to really understand the downside risk they're actually taking. And by giving this additional information, it might be true that just using the standardization is kind of enough to get there. Because just with the standardization, but without this kind of long ranging average perspective, what we've seen or learned in Europe, the standardization alone doesn't help, right? We still have this difference in markups between less and more complicated structures. But maybe as a final point, I just think retail investors, when they invest in these kind of products, they need to be aware what they're actually doing, right? So they are investing in something which the issuer kind of can provide to them, but the conditions to which the issuer can do so are essentially dictated by financial markets as a whole, right? So even if you would assume, so the issuers are completely in favor or completely supportive of the investors, they don't have any markups, right? So they just say, okay, we're just going to do this because you're a valued customer, we want to provide you with this service. Like in that case, what essentially would happen, you would get something which is fairly priced in terms of what financial markets on aggregate have come up. Now, in order to really make money with such a product, you would have to be able to find underlying, or in the more complicated case, underlying combinations for which you know or are relatively sure that financial markets actually overestimate the downside risk for these stocks. Now, if as an investor you feel comfortable to do so, kind of to make the assessment of all these underlyings, of the correlation, everything, and you're sure that the markets actually overestimate how likely it is that you have a really big downside event, then it's potentially possible to kind of have a positive expected return. But if you're not able to do that, then it will be very hard to have a positive expected return across all the scenarios for these particular product types.
Yeah, interesting. So you have to kind of be expressing your view on option pricing or derivative pricing or something like that, and then you can earn, if your view is correct, then you earn a positive return.
Yes, right. So if you think, okay, I'm sure Microsoft is not going to lose more than 25% over the next year, and it happens that you are right, then you make money.
Yep.
But essentially, the premium or the compensation, the coupon you're getting, is by when the issuers actually sell this put to somebody to somebody in the markets, which likely is not a retail investor. So this means you are right if this counterparty, which most likely can be an institutional with more information than you have, actually still, despite that, you are in a better position to make that call, and you actually have more information, you know more precisely that yes, indeed, for Microsoft, it's not going to happen, they're not going to lose. But if option markets are more accurate, then it's going to be really hard to beat that pricing in the long term.
Yeah, so that sounds kind of like if you believe you can be a successful active manager, then maybe this can make sense as a way to express your beliefs. But on average, maybe not such a good idea for retail investors.
No, probably not. And there is another, maybe as a final point, another result we have in the paper, which I haven't had the chance to talk about. So what you can actually do is when you just in a simple exercise, you compare the aggregate portfolio that just consists of the simple type with one underlying, and the aggregate portfolio that consists of the more complex type with the three underlyings in most cases. Sometimes it's more, but mostly it's three. You can run simulations, right? So you can go and see, okay, so for all these underlying stocks, what is the expected return which you would get with a top of the art asset pricing model, right? So you can really try the best you can in order to get kind of forward-looking pricing inputs. And then you can just simulate these portfolios. Now, when we do this, what we find is that the portfolio, which just consists of the simpler product type, actually first order dominates. So the technical term is first order, stochastically dominates the more complicated portfolio. Now, when you think about this, what this means, this actually means that if, as an investor, you have an increasing utility function, just meaning that more money makes you happier, we don't have to make any assumption whether you have to be risk averse or not. Most retail investors are risk averse, but even if you're risk loving, you should never, as an aggregate, invest in this more complicated multi-yield enhancement product portfolio. Never, no matter how your utility function looks like. And we think this is a very, very striking result because we are not comparing like the product with its individual components and find these dominants. We're actually comparing like the simple portfolio with the complex portfolio, and we still get these very strong dominants.
Yeah, unreal. That's a very interesting finding. Cool. Well, this was great. Great research, and we appreciate you coming on to talk about it, which you did a great job doing.
Thank you, Ben. Thanks for having me. Pleasure was all mine. It's always interesting to talk about this stuff with people who are actually willing to look behind the curtain and kind of try to understand what's really going on.
Awesome. Great to meet you, Felix. Thanks.
All right. I think that was a great conversation with Felix Fattinger. Cameron, do you agree?
Oh, fantastic. So such great research and such great insights into something that's pretty complicated.
Yeah, and really well communicated, and some nice takeaways for retail investors, I think. Anyway, so let's go ahead now to our conversation with Petra Vokata. Petra Vokata, welcome to the Rational Reminder podcast.
Thanks for having me.
Petra, what motivated you to do this research on structured products?
So it was to some degree a coincidence, really. So I started to do my PhD back in the days in Finland at Aalto University. And a great thing about doing PhD in Nordic on topics related to investor behavior is that you can observe very granular and rich data about all the investors. And so in Finland, you could see every investor, what kind of stocks they hold, how do they trade. And one thing we noticed when we started to look at the data, the more like newer edition of the data, was that there is a massive increase of the number of investors who buy these weird, exotic securities, which we didn't know what they are. We just knew that these are some kind of structured products. And this was a large number of investors. So we observed hundreds of thousands of investors, which would translate to around 10% of households in Finland. And that kind of adoption rate we observed over less than a decade, pretty much. And so I became interested to understand, okay, what are those securities? How can we get some data on those securities? And I started to talk to a company that the business model of the company was to collect data on structured products and then basically sell the data to banks. And they were so nice to me that they gave me their whole global database of data on structured products. And I was like, oh, wow, this is really fascinating. There is very little research. We don't really know what these products are. Are they good or bad? There was a lot of controversy. Is this actually benefiting investors? And so basically by this coincidence, I started to do research on structured products. Once I got the data, I understood that it doesn't make that much sense to focus just on Finland because Finland is a small market, 5 million population. So once I had the global data, it became apparent that it makes sense to focus on other markets which are easier to study. So mostly these days I focus on the US market.
Incredible. What types of structured products do you look at in your research?
This is a good question because structured products is like an umbrella term for very many different types of securities. So like broadly, you can think of it as a bundle of traditional securities. Most typically, it's going to be a bundle of some derivatives, some option, and either bond or equity. And in my research, because it's really important to establish certain characteristics, such as what are the fees of these securities, for me, it's the easiest to look at the US market, where it's relatively straightforward to calculate what are the embedded fees of the securities because you have very good data on listed options. And also it becomes way easier to focus on securities that are listed to equities, that are linked to equities. Because if we look at securities linked to commodities, we may run into issues of like what are the correct pricing inputs. So mostly I focus on products linked to equities. This is also the largest asset class in the data. So more than half of the products are linked to equities anyway. I focus mainly on the US market. And in particular, I focus on securities called yield enhancement products in most of my research. So the most characteristic feature of the security is that it's going to promise a high coupon, high headline rate, or you can think of it as yield. It's going to be very attractive, say 13% per year. And then at the same time, this high coupon rate is going to be compensated with the downside risk. So it's going to come with an embedded short position and a put option. And so basically the downside is that you may potentially lose all your invested capital.
So you chose these yield enhancement products or YEPs for what sounds like pretty good reasons. Do you think that the research generalizes to other types of structured products?
Yeah, so this is something I want to be like very careful about because as we are going to continue with this conversation, you will see that some of the results I find are quite extreme and they don't paint a very good picture about the benefits of these securities for the investor. And I want to be very careful in not generalizing those results to the whole universe of structured products. So from like a priori theoretical standpoint, you can totally have, good structured products that are reasonably well priced and they can have good benefits for the investors. So I want to be very careful that most of what I'm going to talk about today is going to really apply only to these yield enhancement securities linked to single name equities issued in the US between 2006 and 2015. I don't want to generalize outside of this market because I actually honestly believe that many of the securities outside of this market are going to be better priced and more beneficial. Okay.
What types of securities tend to underlie the structured products in your sample?
So in my sample, it's going to be mainly listed stocks. Okay, so mostly single name. Some of these securities are going to be linked to indices, but that's a minority. So you can think of a typical product is going to be linked to the performance of Apple or Tesla. It's going to be the most typical underlying care.
How do you go about determining the effective fees charged by these products?
Yeah, so this is This is a nice question, and I can give you a half an hour lecture about it, but I'm going to try to simplify it so that we don't lose too many listeners. So the first thing is that you need to understand what exactly is the payoff. And because these securities are very complex and they also are very heterogeneous, they come like in many flavors and many potential payoffs. The first thing you need to do when you analyze data on structured products is to understand what is the payoff formula. The data I got was sort of semi-structured, semi-pre-processed, so there was a short textual description of what is the payoff of the security, but it was like far from perfect. So the first step I needed to do is to basically translate this text into a formula, which you can then evaluate like what exactly would be the price for this formula. Once you have the formula, what you can do is you can sort of debundle the securities. So again, if you think about structured products as a bundle of traditional securities, you can go ahead and decompose the payoff. So to give you one example, if you, for example, have very reverse convertible, you can decompose it into a bond component, so a bond linked to the issuer of the security, bank A, and then the option component, which is going to be short position in a barrier put option. So once you decompose the security, you can then go ahead and price each of the individual components. The bond is going to be relatively easy. You just need to take into account what is the default risk of bank A. The option component is going to depend. Okay, very few of these securities have very simple option components like plain vanilla options. Most of them are going to have some kind of exotic options, which are going to be a bit more difficult to price. So there are different ways how to price those securities. If you don't want to spend too much time, you can make some simplifying assumptions. So assume that implied volatility is constant. So go with the good old Black-Scholes, constant volatility. And then you may use just closed form formulas, and it's going to be relatively straightforward. You just need to get data on what are the prices of options for the particular underlying, and you can go ahead and price the security. If you want to publish in top scientific journals, most likely the referees are going to push you to do something more sophisticated. So I ended up doing local volatility diffusion, where you basically calibrate the local volatility diffusion to the prices of options we observe in the market. And then once you have these local volatility diffusions, you can, for example, use Monte Carlo simulations or finite difference methods to price the exotic payoffs. So once you do these sophisticated option pricing techniques to price the two components, you can sum up the price of all the components, the bond component, the option component, and compare the price of the components with the price the investors pay. So say you find out that the sum of the components is $950, and the bank is charging the investor $1,000, then you have embedded markup of $50. You can calculate what would this mean in annual terms, what would be the annual fee of the security.
So when you do that in the paper, what level of fees do you find that investors are paying?
Yeah, so this is one of the sort of more stunning result of the paper. So again, it's just yield enhancement product. It's only 2006 to 2015, only in the US. That being said, I have more than 28,000 securities in the sample, so this is a very large sample study. I find that on average, the margin, so the difference between the price the investor pays and the price of the component is 3.6%. And if you annualize that, because the expected maturity of these securities is shorter than 1 year, if you annualize this, you will have annual fee of 7%. It gets a little bit better if you weight it by the size of the issuance. So if you volume weight the fee, then it's going to be 6%. Still a number that is, significantly higher than what investors typically pay for passive index funds. So a very expensive product.
Yeah. When I asked earlier about whether the results generalize, you mentioned that you think that these YEPs might be worse than other products out there. Why? Why do you think that is?
Yeah, so I think that's because YEPs tend to have shorter maturity, and particularly the ones in my sample. And I also find that the big determinant of the cost is the maturity of the security. Okay, so basically the embedded fee has a very large fixed component, and it varies a bit with maturity, but not a whole lot. Okay, so if you charge a 4% margin for a 3-month product, you're effectively charging 12% annual fee. If you charge 4% margin for a 4-year product, you are going to charge 1% annual fee. And so that's going to have a big impact on how expensive are these securities. I know that, for example, in Finland, the typical maturity of these securities back in the days, in my sample when I studied, was around 5 years. And so you would expect that these securities would be significantly cheaper. than the securities that I focus on in this paper.
Okay, got it. So they're longer maturity is probably better, but still the fees aren't like index fund level fees.
No, so from the existing papers we have, there is one recent paper using like Swedish data. There, the annual fee was above 1%. So still very far from index funds. And I think that's typically the case also in some like research in Switzerland, etc.
How have the YEP fees evolved over time?
So that's a good news for like investors. I'm not sure for banks, but for investors, the good news is that this sort of general pattern of fee compression that we see in other markets, you can also see this in YEPs in the US. So in the year when I observed the highest fees, that was around 2010, on average, I observed fees of 9%. By 2015, those fees declined to 5%. Okay, that's where my sample ends. So hopefully by 2023, this number may be even lower. So from the perspective of investors, this would be good news that you see a decline in fees in the market.
How do you estimate the expected returns of these products?
Yeah, so this is a great question. So I think once you start to think about what do these fees mean for expected return, I think that's like the most important step to take to understand whether you should be buying those securities or not. And so again, like calculating expected returns can be very sophisticated, and eventually what I do in the paper is more complex method. But let me try to simplify the logic so that the listeners understand how should you think about it. So say you are buying a mutual fund, and say that you assume that the expected equity premia is 5-6%. That's typically what academics agree. Now, if you would be paying 6% fee for that mutual fund, then in net you wouldn't expect any positive return, right? Because the fees are going to wipe out all the equity premia. Now, something similar basically applies to structured retail products. So the difference here is that the beta may not be one. So like if you're buying index fund linked to S&P 500, beta is one, really straightforward. If you're buying structured product, beta may not be one for two reasons. One, the underlying may not be indexed. So in my sample, the average beta is higher than one of the underlying. So on average, maybe 1.5. But at the same time, the delta of the security is not equal to 1. Okay, so it may be, in my data, it's less than half, but let's assume that it's half. Okay, that's because the upside is capped, right? So you receive some attractive coupon, but that coupon is capped. So at some point, you're not going to participate further in the upside. So as a result, your delta cannot be, as high as the delta of investing in the market. So let's say that the delta is half. Let's say that the beta of the underlying is 1.5. That implies that the beta of the product at issuance would be equal to the product of 1.5 times half. You just multiply the beta of the underlying times delta. So we would be having beta of the product 0.75. Now you multiply that with the expected equity premium, say 6%. Your expected gross return on the product is 4%. Okay. It's a very simplified calculation, but this is basically how it works. So if you have expected gross return of 4% and you pay 7% fee, okay, it's really easy to see that you wouldn't expect to get much from the product, right? And that's exactly what happens. So in the paper, I use more sophisticated methods because you can claim that this delta I gave you is just the delta that applies at issuance, and it's going to change over the horizon of the security. So you can do more sophisticated methods. You can basically, again, take these local volatility diffusions, embed there some expectation about the expected return on the underlying, and then you can do, again, tons of Monte Carlo simulations, basically project what would be the payoffs of these securities, and at the end take some average. That would be more sophisticated way how to calculate the expected returns. But I don't think investors need to do this. They can just look at the fee. Once they see the fee, they can try to do some back of the envelope, very simple calculation whether you would expect there to be something left after you pay the fee.
So how do the expected returns compare to the realized returns?
So I didn't yet tell you what exactly the expected returns are. So let me give you these few numbers so that we can then compare it to the realized numbers. If I do this sophisticated calculation, which can be simplified with the simple calculation I gave you, you will get expected return of negative 18 basis points if you calculate it as a total return of the security. If you annualize it, so in annual terms, you will have minus 1%. And this is going to be a little bit depending on the assumptions, but it's going to be somewhere there in the ballpark. If I calculate the actual realized returns over my sample period, I observe average total return minus 3.8%. And if I annualize it, then I observe minus 2.6% negative annual return. A very, very natural follow-up question would be, well, you are looking at 2006 to 2015. Perhaps all of this is driven by 2007 and 8. We have financial crisis in the data, and so should we really focus that much, on these returns? So one interesting statistic: if you look at 1/3 of my securities that have the shortest maturity and therefore the highest fees, as I said, maturity translates into higher fees.
Mm-hmm.
I observe negative average returns in 8 out of the 10 years in my sample. Okay, so this is not driven by the crisis. This is driven by the high fees of security.
Yeah, that's crazy stuff. How do we know? So we've got some negative returns, maybe negative expected returns net of fees and negative realized returns. How do we know that there isn't some hedging property that some investors are just willing to pay these high fees or accept these low expected returns in exchange for?
Yeah, so it's a good question. It's kind of a typical question from a textbook finance, right? Because by textbook finance models, whenever investors are willing to buy something with negative expected returns, it must be that there is some huge hedging benefit. I'm still waiting to meet an investor who would tell me that his or her investment rationale was hedging. I met investors who get very good reasons to buy some of these securities. So it could be, for example, for access. These securities were linked to some underlying that they couldn't otherwise get access to, or they have some kind of speculative motive. They believe, that some outcomes are more likely. So I definitely met sophisticated investors who have reasonable investment rationale. These were not related to hedging. But to give you sort of more, academic answer why I believe that hedging really doesn't apply to the U.S. market. One good reason of focusing on the U.S. market is that in U.S. investors have a really, really good access to listed options, way better than in some European markets. And so you can basically compare what would be the additional hedging benefits from yield enhancement products compared to buying some alternative constructed from listed options. And so one exercise I do in the paper is that I contrast the payoff of yield enhancement products to the closest payoffs you can get from a combination of max 2 options. So you are buying either 1 or 2 options, which you can very easily buy online. And I'm constraining it only to positions for which you don't even need a margin account. So something really easily accessible to investors. And I find that almost in half of the cases, so 45% of the products, you would get a payoff from listed option that is state by state dominating the payoff of the apps. Okay, so in any state of the world, independent of the performance of the underlying, say the stock of Apple, you would always get high return from just selling, put option easily through your online broker than from buying yield enhancement products. So to kind of rationalize any kind of hedging benefits, you would need to have an investor who is not sophisticated enough to know how to sell a put option, yet sophisticated enough to understand that he or she should be buying yield enhancement products for some exotic hedging need. This seems really like a stretch. And then on top of that, these securities are positively correlated with, the stock market. They are positively correlated with consumption and also with labor income. So they also do not sort of naturally serve as a hedging instrument either.
Yeah, that's a pretty good argument. Yeah. How do the auto call features that a lot of these products have, how do they, or how can they be used to manipulate the attractive annualized returns that often get promoted to investors? And this is something, I've seen this in product literature where you see these huge annualized return numbers that they're suggesting you can get.
Yeah, no, I'm so glad you're asking this question, because it's also a regulatory challenge of these auto calls. So I see all sorts of regulators across the globe coming up with new disclosure for auto calls, which is kind of using the same manipulated average returns as I described in my research. And so this is clearly a very pervasive bias in displaying returns and fees of auto callable securities. So let me first explain what auto calls are, because Not everyone knows what is autocallable. So this is going to be a security which is going to have an automatic call feature embedded in the payoff. So most typically, it would say if the price of the underlying stock is above the price at issuance at certain calendar, at certain date, then the security is going to be automatically called back and the investor is going to receive some coupon. And oftentimes, these call features, they apply as early as 3 months after issuance. So you buy a security and in 3 months, it can be called back. Now, why does this matter? It matters because the positive or negative performance of the securities is going to strongly correlate with the term of the security. Okay, so whenever the security is called early, it's usually going to be the positive return, which is going to apply to very, very short horizon. And then when the security is not called and you hold it until maturity, these are going to be the situations when the return may be significantly lower. So I can give you just like one example, which may make it easier to understand how exactly is this biasing the returns. Suppose that you have autocall, which promises 20% coupon. So a nice, attractive coupon rate. You buy it first. It's going to be called after 3 months. You are going to receive 5% coupon. You buy it a second time. It's going to be called again after 3 months. You will receive another 5% coupon. And then you buy it a third time. And this time it's not going to be called. You are going to hold it until maturity, which is going to be 1 year. And at maturity, you are going to lose 20%. Okay, so if you would want to calculate the total return from this investment strategy, you got 5%, 5%, minus 20%. In total, you lost more than 10% from rolling over these investments. If you calculate the average annualized return, it's going to be 20% for the first investment, 20% for the second one, because that's the annualized return, right? You annualize over a whole year, and then minus 20% for the third one. So if you calculate average annualized return, you will see a return of more than, it's going to be around 7%, right? Mm-hmm. So you can see that the actual sort of total return versus the average of annualized returns can be pretty far from each other. And this is a mechanical bias that you're going to always see whenever you have basically path-dependent maturity and path-dependent performance.
How meaningful is that bias in annualized returns?
Yeah, so it can be quite dramatic. So in my data where I analyzed over 7,500 autocalls, I see that the average annualized return is 6%. So that looks good, right? That's a nice return potentially. That's using the bias measure, so averages of annualized returns. If I look at average total return, it's negative 1%. If I look at term-weighted annualized return, I'm seeing negative 2%. Okay, so these two simple comparisons would give you that the bias is around 8%, and it reverts the sign, right? So something that looks like positive performance may actually have a negative.
That's unreal.
That is, those are big numbers. You created.
If I can just add, the reason this matters is that usually this is like the most frequently displayed metric for autocalls. It's usually displayed by market participants who may be conflicted. Okay, so it can either someone who is like structuring these securities, selling these securities, or someone who is somehow connected, to the market. That's why it matters. But you sometimes see it even in academic papers. So that's sort of that's not necessarily because of conflict, but really because it's a very natural way how to calculate performance. And I have also seen situations where regulators use these kind of biased metrics, and they are somewhat aware that this is not ideal. But when they hear from you what is the optimal way how to calculate the correct measure, which is using some expected term of the security, etc., it gets so complicated that basically it's just way easier to just take the average.
When you created which was what I was going to ask about next, the indexes of YEPs, is that one of the ways to deal with the issue that we just talked about?
Precisely. So it's not an easy metric to calculate, right? Because you need to be able to create an index. But I think it's the optimal way because first, investors understand what index means, right? So it's like a time series path performance. So it's really easy for them to interpret if it's calculated correctly. If you do that, you will see that autocalls are not outperforming other YEPs in my data. You will see that in many periods they do have negative or like around zero returns, and this would be exactly the way how to correctly measure the performance. So you create an index where you basically roll over the investment on every day to new autocalls, so that you weight the term of the product correctly, and you do not overweight the securities, which were called only after 3 months.
Right. Okay. And so when you do that, you created that index and then you compared it to a risk appropriate benchmark. Can you talk about what that looked like?
Yeah. You will not be surprised that it doesn't look that great for the products, right? Given the fees they charge. So I chose as a benchmark the SIBO S&P 500 put right index, because this is basically index from a hypothetical strategy that sells put options into S&P 500, and so that would be sort of similar to the short position and put option that YAPS in my data embed. And if you compare it to SIBO put index, you will see an annualized alpha of 8%. Okay, so that would be actually even worse than the average fee that the securities charge.
So it's the fees that explain the underperformance?
Yeah, so partially. So this negative 8%, around 5% of that is explained by fees. There is an additional negative 3% return to underperformance, which is explained by the choice of the underlying. Okay, so remember, my products are mainly linked to common stocks, whereas here the benchmark is SIBO S&P 500 put index. It turns out that it's not just the fees, but also the choice of the underlying that doesn't serve investors that well. This is going to be also something you're not going to be, surprised. So like your podcast, for example, on thematic ETFs, right? Like this kind of pattern that the choice of the underlying may not always work for the investor. This is not unique to structured product. There is a very nice JF paper by Neil Pearson, who is a professor at the University of Illinois at Urbana-Champaign, and he basically shows that the choice of the underlyings in this market is very consistent with catering to investor sentiment. We are basically choosing Tesla at a time when investors overvalue Tesla, and as a result, after issuance, you are going to get also negative returns from the performance of the underlying.
That's unreal. So they're paying high fees and they're getting attention grabbing securities underlying the product.
Yes.
How important are, and maybe you can also explain what headline rates of return are, but how important are headline rates of return to investor demand for these products?
Yes, I believe this is like one way how to rationalize why we see these securities. So by headline rate, like in the context of yield enhancement product, the coupon would be one headline rate. So it's the rate of the promote coupon that you see very prominently advertised, sometimes even in the name of the security, but if not in the name, it's going to be very early in the prospectus. You will see what is the annualized coupon that the security offers. It's not the only very salient trait. So also the downside risk protection. So basically the threshold up until which you are protected from the downside price movement of the underlying, it's also going to be very saliently, very prominently displayed in the prospectus. And so if you try to understand what explains the demand for the security, so why some securities attract higher demand and other securities attract lower demand, it seems to be that these rates of these headline rates, so the coupons and the downside barriers, explain actually a lot in the sales volume. And so I believe this is what makes the product look attractive, okay? Because on these salient attributes, these salient headline rates, these securities do look attractive. So often 20% annual coupon, protection up to 30% downside price movement. So this on its own, if you do not look at all the additional features of these securities, that may look very attractive. And so that may explain why investors find the securities attractive. What do banks do to increase headline rates of return? Yeah, and so that's an additional piece of evidence that suggests that this may be very important. So if you study the choice of the payoff structure, so you can think of it as a choice of payoff. You can think of it as a choice of complexity. You can think of it as a choice of the embedded exotic features of the security. These are all basically different names for the same phenomena. I find in my data a very robust pattern that this choice of exotics leads to more attractive headline rate. Okay, so you could structure a yield enhancement product with a plain vanilla option, but it would not offer, for example, 20% annual coupon because you couldn't structure it so attractively. So instead of choosing plain vanilla put option, you may choose a barrier put option, which is going to be way cheaper to structure, and it's going to allow you to, instead of offering 5% coupon, to offer 20% coupon. This is something that I would be more confident saying that this generalizes to other markets, because I have seen the same patterns also in outside of US, so also in Europe. I have seen it in Asia. I have also seen it in classes of products called capital protected securities, which are very different from yield enhancement products. So I think this sort of choice of exotic features, these modulations of the payoff, to make the headline rates look more attractive, I think that's a very, very robust stylized pattern that applies to structured products.
Okay, so headline rates of return, this is like the best case scenario return kind of thing.
Exactly.
And that's what gets marketed. How does the headline rate of return relate to expected returns on the product?
Yeah, so in theory, so it depends. In theory, if you have two exactly identical products, so they have the same exotics, higher headline return basically means that the security is better. Okay, so there is a good reason why investors should be paying attention to these headline returns, because in theory, if everything else is equal, this basically is reasonable statistic to look at. In practice, because banks are using these exotic features, these additional embedded exotic options, that's not always the case, right? Because you can increase the headline return just by manipulating the payoff. Okay, and so in my research, I show that basically because headline returns are more related to the exotics than they are related to the quality of the security, they do not directly translate to higher expected returns. In fact, large fraction of them does not translate to higher returns. It translates to lower returns because the higher is the headline rate, the higher is the fee of the security. And so it basically reverts the sort of intuition that I tried to explain at the beginning, that all else equal, this is something you should look at. That applies only if you do not manipulate the exotics, because there is a lot of this additional exotics in the payoff. It reverts the relationship, the positive relationship, and it leads to the negative relationship.
Yeah, it's super interesting. So that's like if two issuers had the exact same underlying, but one of them got better pricing on the option, I guess, then they would be able to give you a higher coupon.
Exactly.
And it would be the same payoff. But in reality, they're doing a bunch of engineering to make the headline rate higher, but they're actually lowering the expected return by doing that.
I think you said it way better than I did, yes, but that's exactly what is happening.
It's crazy.
What do your research findings suggest about who benefits from this kind of financial product innovation?
So in questions like this, I again want to be very careful not to overly generalize to all structured products or all financial innovation. I can tell you that in my data, if you consider a natural benchmark for the investors buying options, buying cheap passive funds, or just keeping their money in mattresses, then you can make the claim that investors on average do not benefit from this innovation. You can quantify how much money from the fees goes to the brokers, so the advisors, brokers who are recommending these securities. That's going to be about half of the fees, so 3.5% goes to the brokers. So clearly, that's a higher commission than you would pay for just like trading options. The second part goes to the banks. So that's suggestive of the brokers and the banks benefiting. But obviously, the banks may have additional costs, which I do not observe. They need to set up a structuring desk. There can be all sorts of like legal costs. So I cannot make very strong claims about whether the banks benefit. There were also some interesting cases where like banks wrongly hedged the product, right? So it's not obvious that it's a hugely beneficial product for the banks. But I think my line of work establishes that, especially in some contexts and in some pockets of the market, it's really hard to see that these products would benefit the investor. That doesn't mean that structured products in general cannot benefit investors. So there could totally be other markets where the products are cheaper and they work for investors.
Yeah, and you mentioned the embedded commission for advisors. That's one of the counter arguments that I've heard when I talk about structured products, is that advisors can access them without embedded commission, and in that case, it's going to be that much better for the end investor.
Yeah, it's going to make a big difference. Yeah.
So, given all the stuff that we talked about, why do you think retail investors are still buying these products?
Yeah, it's a big question, right? I don't think there's like a one single explanation. I just also do research on like Ponzi schemes, right? And so you can ask questions, why do investors invest in Ponzi schemes, right? So there are probably some reasons they find them attractive. My evidence shows that like one reason for which there seems to be an evidence is that they overweight these attractive headline rates, the best case scenarios, and they may not fully understand the costs of these securities. So I think that can be one explanation. Whenever I present this, in some academic seminars, there would typically be some professor who says, oh, I bought these securities and I'm sure I understood the embedded cost. So I don't want to say that everyone is buying it because everyone doesn't understand. Clearly, there are some other reasons. Could be speculative reasons. It could be access in some European markets. It could be other reasons. But I think there is a good amount of evidence now that one of the reasons is that investors may be overweighting these salient headline rates and underweighting the actual cost of the security.
So what do you think are the main lessons in your research for retail investors?
That's going to be very boring answer, almost like a regulatory answer. Do not buy something you do not understand, right? So these are very complex securities. If you are not confident that you fully understand the payoff and what is the fee, you shouldn't be buying those securities. So you should make sure that you understand them. I think the same applies to advisors. I found every now and then I receive an email from some financial advisor who is, recommending his or her clients to buy those securities. And they may even sort of very honestly disclose that they have no idea what the fee is, but the security offers 20% coupon and it has, 20% protection on the downside. So it does look attractive to them. So that would be my advice even to advisors. If you cannot quantify what is the fee, if you're not confident, what is the cost, which directly translates into the expected return, do not recommend this to your investors either.
If you can't do the, I don't remember the word, the volatility, diffusion, valuation.
Diffusion. There are simpler ways, at least, so to get some, back of the envelope, ballpark answer.
Yeah, okay. No, that's a good answer. Well, Petra, this has been great. Your research on this is fantastic, and I think you did a great job describing it to us.
Thanks so much for having me. I hope it's going to help to, shed light to investors on what this market is about and what to pay attention to.
Without a doubt, that was great. Thanks, Petra.
All right, so that's the end of our conversation with Petra Vokata, and that's the end of that segment. I mean, two really, really good conversations, a ton of good insights, some really great research, and lots of interesting tidbits of information and takeaways.
Pretty cool, the data set that she had access to kick off, the Finland data set that she could dig into, and then to broaden that to the United States. And I think that you spend a career studying this kind of stuff and have that kind of access to information and insights coming out of it is just sensational.
Yeah, really cool stuff.
Okay, so we're good to move on, Ben?
Yep.
So we're going to do one episode in 60 seconds for the time that Jill Schlesinger joined us in episode 67, and then we're going to jump into a conversation I had with her about her book. I think you were away that day, Ben, so I took that one. So we first met Jill back in 2019, as she is a very good friend of a friend of ours, Michael, in New York City. And I met her in New York City when I happened to be there. I went for lunch, and this is one wildly engaging powerhouse woman. She's incredible. And conversation at lunch was great. And she said, sure, I'd love to come on your podcast. So here's my summary of that conversation. Then I'll talk about her book after that. So Jill Schlesinger was our special guest on episode 67, and that episode was called The Pursuit of Finances and Fun. Jill has a background as a trader on Wall Street, then a financial advisor, and is now a personal finance personality on CBS News, and also has her own podcast, Jill on Money. She also wrote the book, The Dumb Things Smart People Do with Their Money, which, of course, is what we talked about. Her background, combined with her current career in the media, has given her an unbelievable front row seat to so many dumb things, which is exactly what she wrote about. And even with access to so much rational information, we are human, she says, and we make choices that can cause financial damage caused by things like blind spots and overconfidence. She also explained the value that she gets from her financial advisor, even though much of the work she could do herself. This then led to a conversation of the kinds of questions you should ask a potential financial advisor and how there's so much more to managing that in that job than managing the funds. And then we also talked about the FIRE movement, Anyways, incredible conversation, incredible interview. And that was Jill Schlesinger, episode 67. So Jill then released a second book earlier this year called The Great Money Reset. Change your work, change your wealth, change your life. It was a really interesting book, very pragmatic book for people who are considering a pretty big shift in their life. It's exactly what the title suggests. So we reached out to Jill, and here's our conversation with Jill Schlesinger. Jill, it's great to have you back on the Rational Reminder podcast.
I am delighted to be with you. Thanks for having me.
I'm so happy to have you. I loved your book, The Great Money Reset. So congratulations on your most recent book.
Thank you. It was a fun book to write, actually. The first one was like agony. This one was really great.
Oh, isn't that interesting? Why?
I had to write that first book. It's like the sort of my take on financial planning 101. And as you know, there are about 1,000 million trillion books written about finance, personal finance 101. I was trying to do it with a little bit of my own imprint on the topic, but it's well covered. And I felt like it was a real like eat your vegetables kind of book, which, I think is important. But this book was born of my decades in the business of financial services, and really, I think, tracks really well with my own progress in terms of being more expansive and thinking about what people really want to hear when they're asking about financial matters, and also incorporating this crazy, daunting, frightening, and liberating experience called the pandemic.
Wow, what a great setup. So what is the Great Money Reset?
Well, this is a concept that I think many people would be familiar with, that at inflection points in your life, it could be a birth, it could be a death, it could be an illness, it could be a divorce, that something very dramatic will make you consider, is this really the life I want to live? And I think that the pandemic forced us, or many of us collectively, to ponder that question. This book is a response to all of the thousands of emails that I was receiving, both before, but mostly during the pandemic, after those first few months went by, from people who really wanted to consider alternate routes than the routes they were pursuing. And I realized that what I was doing over and over with many of these people was taking them through some guidelines. And so I thought the book was sort of an homage to all of those people who asked for help, told their stories, and shared them with me and with the Jill on Money audience, and allowed me to articulate and detail the steps you should be considering and the things you should be asking yourself when you are contemplating a reset of your life. And it doesn't have to be blowing up your life. It could be a new career. It could be changing a locale. It could be, should I go back to school? All of these questions are questions to ask. And I just think that experience of living the pandemic and really forced to being with inside yourself, watching hundreds of thousands, more than 1 million Americans die, and people who knew people and were scared. And I think that it was a wake-up call to many of us. And this book is hopefully a way to help you contemplate making changes in your life without a once-in-a-century pandemic forcing you to do so.
Now, something you talked about in the book is that many people feel like they lack permission to consider a reset. Was one of your goals to set up a framework to enable permission, or is it more than that?
I think that we're tough on ourselves. I mean, at least the people that I encounter, and they'll say things, well, I couldn't do that. Well, why can't you? And so I think that as somebody who has reset a couple of times in my own life, that sometimes there seems to be an obstacle that's in the way. And usually when I've walked through the different scenarios, the obstacle is really you, that you're fearful. I get it. That you are anxious, that you don't want to blow up your entire life, that you want to limit downside risk. All those things are really good. That's like what makes you a human being, is that you can contemplate those things. I just think that for so many people, the permission structure is, let me walk you through the numbers aspect of this. Let me give you some questions. let me tell you some stories about how people were really imaginative about what their next steps could be. And let's see if that helps as many people as possible.
Now, you're a finance person, and you talk about in the book how you must have your financial house in order. Can you talk about the 5 steps you highlighted that someone must go through before any reset?
I think that what's important is that although I talk a lot about psychology and emotional issues, I do boil it back down to the numbers, right? So I think that when you are considering a reset, a good place to start is kind of what a financial planner would do, which is what I know you guys do, which is, hey, let's talk about what are your resources, right? So if you say, okay, my resources, my assets, yes, you list all the stuff that you own. But the other part of your resources is, what is my job providing me? What is my income? What are the benefits that I receive? What are the things that I get through my workplace that would be expensive or hard to, if not impossible, to replicate outside of my employment? That's a really interesting exercise, because often people will go through it and say, oh, yeah, I forgot I had disability insurance. That is expensive. Or, gosh, I'm part of this long-term care group policy. I couldn't get that on my own. Right. So there are things that are available to you. So if we're going to talk about your assets, then, you're going to force me, because that's the way my mind thinks, to talk about your liabilities and to consider your obligations, your debts. And this is important, not because you're supposed to have zero debt, because I am not a believer in that. It's just that we need to understand what's out there for you. And a mortgage can be out there, a student loan can be out there, an auto loan can be out there.
Yeah.
That's okay, that's fine. And we just really want you to look at that. I think considering your housing situation is really important, because when you look at your house, it is often a massive asset for many of us. Especially, and even housing prices might have gone down a little bit month over month, but if you look over the last few decades, people have really made quite a bit of money on their homes. And yet, for some reason, we just, I don't know, feel like that's sacrosanct. Why can't I look at my house? Why can't that be something that is part of my overall game plan? That should be something that I would think about. And also, what about my housing situation has changed, perhaps? I think that during the pandemic, a lot of people said, well, I'm really far from my aging parents. That was kind of scary. And that was a big moment where people said, I don't want to be so far away anymore. So I think that's important. I think that talking to your partner and really understanding, have I made some promise to you? Is there an obligation that I have to fulfill that's not just a financial one? But if Cameron and I, we're married and we've lived a life a certain way, I'm not just going to blow up my life and make big choices that are going to impact a partner without talking to my partner. So these are just some of the things that we kind of start the process with. And of course, everyone's favorite, which is, how much money are you spending? I'm sorry, it sucks. But it really does matter, and it does impact many of the choices that you will make down the road.
I'm so glad you mentioned spending, because I think a lot of people question their spending coming out of the pandemic. So is this one of the silver linings of the pandemic? And I'd like you to link that to anything you know about the psychology of kind of resetting people's spending habits.
It's so interesting to me, because if it's like this wild lesson in how the thing that you have just gone through really does inform you. And so when you think about this, when you are calculating what you own and what you owe and your income, spending doesn't seem to get a high enough priority to me. And yet during the pandemic, what did I hear from people? I'm saving so much money. The government estimates, the Federal Reserve estimates that there was $2.7 trillion of excess savings. People were sitting at home. You can't buy that much bounty. You save money. And people would say to me, like, gosh, I really have prioritized what's important. Like, I get it now. All those things that I said, I'm living paycheck to paycheck, making $500,000 a year. A lot of that paycheck to paycheck was choices you made about your spending patterns. Then we come out of the pandemic. And I don't know about you, but I know a lot of people who are spending quite a bit of money. And I understand that. You are entitled in some sense to have a little splurge. But as I speak to you now, more than 3 years from the beginning of that pandemic, where people had to batten down the hatches, where they really understood what their spending habits could be, and now they maybe went a little bit nuts, what I'd love for people to consider is to say, how might I go more back towards my pandemic spending patterns that are more sustainable in the future? You're not going to not spend money forever, right? That's just not going to happen. But are there certain things that you really didn't miss all that much that you can now say, all right, yes, I went on an expensive trip, but am I going to do that every single year? Yes, I wanted my kids to have some quote unquote experience. I don't know if it's a batting coach, if your daughter's a soccer goalie and you wanted to get her a private coach to get her. Okay, that's past now. Can we recalibrate that and see if you can come to a different place with your spending where you are more consistent, where you're not, it's almost like you don't want, like, you know how everyone hates volatile markets? I feel like the last 3 years has been such a crazy volatile period for spending. And I'd love to regress to the mean in some respects to try to say, okay, I'd like to take some of those habits. For me personally, like, I just don't spend as much money on clothes anymore. I really don't. Yeah. And I know I have to do it for work. But the funniest story is that I think it was in 2020. So in the beginning of 21, I'm sending all my stuff to my CPA. And he's like, I think that did you leave a zero off in your clothing budget? Because I can deduct my clothes because it's a work thing, right? I'm like, nope. He's like, wait, what? I said, nope.
Wow.
And yeah, and it was significant. And, you know, as much as I was like, people in this business, they're like, oh, you can't wear I'm not on the air every day. So if I wear the same thing that I wore 7 weeks ago, big deal. Like, honestly, I don't care anymore. Are people paying attention to my content? I think so. And yeah, there's going to be some people who'll be like, your hair needs coloring and you wore those shoes 3 days ago. Okay. I don't even have to answer that. So that's, for me, the two areas that I felt in our family that we really did shift is we cook way more at home now. And I do not spend as nearly as much as I did on clothes.
Yeah, we're the same. So once someone has dug into their financial situation, understands their adequate spending level, what other general financial advice would you have for someone who decides they want to do a reset?
Well, I think that when you're considering a reset, I think that you really have to start articulating different pathways forward. So I'll just use my own reset as an example of that. I was in financial services for most of my career. Mm-hmm. I owned a business for 14 years, a financial planning and investment management firm. I had sold the business. I was finishing a contract, just like a workout to transition to the new ownership. And as I came to the end of that, I really thought to myself, you know what? I've been on the radio, I've been on TV, I've been doing some writing. I wonder if I could do that for real. So for real meant to me, like, can I make a living doing that? And I mapped out, I of course went through those areas where I could, tackle the numbers. To me, that was sort of the easy thing, calculating what I own and what I owe and the income and how much I was spending and, really thinking about all of those aspects. But then I went into like, well, what are the jobs that are out there? Or what could the next reset look like? And so I kind of looked at it in 3 scenarios, like, plan A, B, and C. I always feel like A and C take care of themselves. Like, I'm a little bit of a nervous Nelly, so I always do the downside first. I said, okay, let's say I've sold my company and I have a bunch of money saved, and I'm going to give myself a year to figure out where I land next. And the worst case scenario is that if in a year, because it was coming out of the financial crisis, so I wasn't sure about like the economy, what could I do? I know how to sell. I'll be able to sell no matter what. Worst case scenario, people need salespeople. I know how to sell. I'll make a living. Worst case scenario. Best case scenario, I don't know, like one of these networks that I've been on hires me to do something or gives me enough money so that I figure out whether or not I like this business called media. And the middle case, which is probably the most likely scenario, was, I'd work in some financial services organization, doing some stuff for them, maybe incorporating some writing on the side, maybe doing a little TV on the side, but that, I knew that I had value in what I brought to the table in that world. And that was the most likely scenario. And I spoke to a ton of people in the financial planning world who were like, you have a place here if you need it. So in the old world of my old world trading, which was I was stopped out. I had a game plan. I knew that I could pursue one of those three routes and I'd be okay. And I didn't know which one was going to be the one that landed in my lap. It just so happens that because of the financial crisis, because we were driving into a recession, I was on television quite a bit as a guest. And someone from CBS News called me and said, can we talk to you? We think we have something that you might be interested in. And so it was the beginning of 2009. And I went in and said, I'm exhausted. I've owned my own company. I've been working 7 days a week for 14 years. I just need a break. I'm happy to talk to you, but like, I'm not ready to do anything till after the summer. And 3 weeks later, in the beginning of April of 2009, I signed a contract and I've been with CBS News since.
Just makes you the perfect person to write this book. It's a great story. There's inspiration in there too. A really practical part of your book, you talked about negotiating your compensation. And I think you framed it as bully your boss. You got to talk about that.
Well, I got to tell you something, that when I wrote this book, it was a different time in terms of the labor market. People were like, they're like, oh my God, I am going to kill my boss. I'm going into a negotiation. I know exactly what I have to do, and I'm going to extract my pound of flesh. Okay, well, times change and the labor market is different. But in general, I do believe that we need some better tools to walk into a conversation with our bosses, right? And so when I say button up your ask the B, okay, so the bully is silly, but so let me talk in like real terms. So it means that you need to prepare for what you are asking your boss to do. And the preparation means that you need to be clear about your worth. It means doing some research. It's understanding, that's the landscape of really what is going on in your company, in your sector, in the economy in general. And what is your value? What are you bringing to the table? And how do you articulate that? I also think that people sometimes go into these conversations and it's just money. And they cannot be that the only thing you're asking for is money. There may be other areas. For so many that I know now, they said, you know what? I don't want to work 5 days a week. I'm going to go find a place. I will make less money every year if I don't have to commute for 5 full days a week. And so I want people to be really introspective about finding out what they want, understanding what the boss's position is, understanding that the boss has a boss also, or is maybe the owner and has different competing forces.
Yep.
And to practice the ask with somebody who is really going to help you focus your conversation. And for some, like for my nieces and nephews, and many times I will play the boss, the like curmudgeonly boss. So like I always joke that I had an interview once with somebody, and then I was talking, afterwards, and I said, who person becomes my boss, and I said, this is what you did during the interview. Like leaned and like did not look at me, did not pay attention, did not do anything, and he's like, I did. He goes, I can't believe I did that. I'm like, yeah, you were kind of an like that's really what happened, and I think that it was funny to me that. He's like, I don't remember that at all. I mean, he goes, I just remember like when we were hiring, like there was so much going on and maybe I was distracted. It made me like, yeah, you know what? Your boss is a human being also. And if you don't get exactly what you want, or your boss isn't really receptive in that moment, sometimes you don't know what's going on. Sometimes you do, but try the why is don't yuck it up, which is like, don't pound the table, walk away, hold your head up high. And if you really do think this is not the right place for me, and you don't like the reaction you got, do not quit on the spot. That is not what you do. Even if you had another offer in hand, I really don't think that's in your best interest. I think it's very much in your best interest to talk to your boss, keep a conversation going. And just remember, you have a very major league opportunity to keep that door open as long as you act with grace and dignity in that moment. If you act like a petulant child, your boss may be thinking like, oh, I just really got pushed into a corner. I gave Jill what she wanted. But then the next time the economy rolls over, maybe it's that Jill who will go out first. So just be careful when you're doing your entire, your conversations about negotiating salary and benefits and time off. All of those things are really important.
Very pragmatic and solid advice. So someone's thinking about a reset. How far ahead should they be thinking about that?
Well, oftentimes what I'm hearing from people, and it's like, I need to make a decision tomorrow, I don't think we make the greatest decisions. So what I'd like maybe the average worker, mid-cycle worker, right? So if you're in your 30s and your 40s and you're thinking like, where am I? I think reading this book might spur you to consider that maybe the job you're in right now, the career you're in, is not the path that you may be wanting to pursue. And is there a way, if you start this conversation early enough in your career, so you carve out a few different ideas about what could happen next? I just spoke to a young man who's 37, 38 years old. He and his wife are both CPAs. And he said, I don't want to work 7 days a week. Like and I'm doing that whether it's tax season or not. Like, I don't want to do that. And what I realized was that he was sort of saying to me, I'm willing to do that for a little while, but I need a way out. And so we started to consider, well, okay, would it be both of you making that decision? Is it you and is it just you or you? And so we started having these conversations, and it's really fascinating to me that he could make $50,000, $60,000, $70,000 a year less, and they would be fine. They've been working really hard. Again, talking about that permission, I think that he kind of knows the numbers, and he was saying to me, do you really think it's going to be okay? And I'm like, yeah, it's going to be okay. You got to make some money. You may not make $150,000 a year at the other side of this, but if you made $75,000, $80,000, or $90,000, and you had a job where it was a more sustainable job for you for a longer period of time, and you actually enjoy what you're doing and have a life, oh my God, yeah, that's great. So I think that can happen at any time. I think for people who are maybe later in their career, so maybe in your 50s, I'm often like a little stunned on my own show where people are like, I'm 55 and I want to be retired. I'm like, really? That's kind of young. Like, that's 40 years of unemployment, or 30 years of unemployment, meaning, retirement. And also, what are you going to do? So I think that if you're the kind of person who really wants to be engaged, but not at this same pressure point and level, in your 50s is a great time to be thinking, well, what else? What's my off ramp? I don't want to, I feel like sometimes what we do is we talk about retirement as this event, which is, you come to the end of the cliff, you jump off, you're now retired. And I think for most people that I know, and most of, my cohorts who are in their 50s and even the early 60s, they're seeking a different kind of an existence in the 50s, 60s, and 70s. And it's not necessarily, I got to move to the Sun Belt and play golf all day long. They do want to do something. Yep. And I think that is what you need to be thinking about. What's my transitional phase? Is it my own business? Is it a side hustle that's a business? Am I a consultant? Do I join up with someone else who's doing something really interesting and I can lend my expertise to that? All these are great options.
Any final pieces of advice for anyone considering a reset?
Oh, well, listen, I have to be clear that pretty much anybody can do a reset. It's really mostly your fear that can stand in the way. And I don't want you to think that, you have to go back and go into in-depth therapy, but I do think that for many people, we will place onto our jobs and our careers a lot of the dissatisfaction in our lives. And so without sounding too hokey, I think that when you go through a reset process, what it can do is it can help you prioritize things that are going on in your life and lay out options. And the options don't have to be black and white. You don't have to do one or the other. There can be a middle period where you're not sure. And some people will go through a process and come to the end of it and say, I'm actually okay where I am. Now that I think about it, given the things I would have to maybe give up or do differently, maybe I'll stay where I am. I am always struck by the fact that I'm in a business that where all I do is I talk about money. And what I always come to the conclusion of is that when I've talked to people on the air, when I get emails from people, resetting is really not about the money. It is really about your own resilience and giving you choices and opportunities. That's what your money is for. It's not to pile up on a balance sheet. It's there for you to work for you and to make you happier and more, and maybe more content for the longest period of time possible.
Again, the book is The Great Money Reset. Change your work, change your wealth, change your life. Jill, it was so great to have you back.
Well, thank you so much for having me. I really appreciate it.
Thanks to Jill for joining us again. And then time for the after show, Ben. How do you feel after 3 weeks off?
Yeah, pretty good. The first week that I was off, I'd been sick. So I spent a few days, I'd been sick before the time that I was supposed to be off. So I ended up spending, I think, most of the first week catching up on the stuff that I couldn't do while I was sick, work related stuff. So I don't know if I was really off for that first week. And then the second week that I was off, I spent like 90% of my waking hours in what used to be the forest in front of my house with a chainsaw. And there's no longer a forest in front of my house.
Oh, it's like I had a chance to visit Ben's place while he was off. And this yard that you've created is like the ultimate area for adventure for your kids. It is incredible space.
It's still a bit of a blank canvas, not quite a yard, but it's an area that used to have trees on it that no longer does, but still
lots of adventure space. Yeah. You can see that you hanging out there and it's so cool. It's not like flat. It's like little hilly and tree stumps and trees, and it's a big rock, that massive rock in your yard.
Two big rocks. So yeah, it's a really, really cool space. So lots of work to go there, but anyway, spent a bunch of time there. And then I got a mountain bike that I ordered about a year ago because I'm pretty tall, so I can't just go buy a mountain bike. So I had to have one made to my size, my measurements. And I finally got it. It took a while because of all the COVID related stuff. And so I spent a bunch of time riding out in the trails around where I live. And yesterday, actually, I was out in the trails probably at the wrong time because around dusk and dawn is when bears tend to be out.
Oh no!
I was there a little probably too close to dusk, which is usually fine. But had an encounter with a black bear while I was out in the trail.
How close?
15 feet. I had a bear bell on my bike. Like I was prepared for this situation. So the bear bell alerted the bear that I was coming. And by the time that I saw it, it was already in the bushes walking away from where I was. But it was very curious, looking back with its ears perked up, walking away, but looking back at me. And I was like, nope, I'm out of here. So I turned around.
Wow.
Went back the way I came. Yep. Anyway, that was my time off. Lots of fun.
Yeah, so I had a chance to see Ben's basketball setup in his family room. So you and I were talking about, I thought this was so funny, talking about what about a dining room table here? And what did you say? Oh, it'll impact my 3-point line here.
Yeah, I can't put a dining room table. It's going to get in the way of my 3-point line.
It's so funny. And it's an awesome setup you've got up there. Very, very cool. So we had a nice review posted on Apple this week. Do you want to read the review from Martin?
Yeah, this is a very nice review. They're all very nice. This one was particularly nice. They titled the review, "The Only Podcast I Won't Miss, a 5-star plus podcast." I came across a Rash Reminder about 3 years ago when I saw a post on LinkedIn from a respected acquaintance who called it the best finance podcast in Canada. I haven't missed an episode since, and I eagerly anticipate every Thursday morning's release. Ben and Cameron have a wonderful rapport and offer something for everyone, from the hardcore finance wonk to the individual who is just trying to figure out what personal finance is all about. They are exceedingly bright and share their knowledge while remaining open to new ideas and to being persuaded by better information, the definition of being rational, in my opinion. They're truly doing a public service. My only regret is that it took me 3 years to write this review and to express my gratitude. Thank you and keep up the tremendous work. Your efforts are truly appreciated. P.S. I'd love to see a Rash Reminder baseball/trucker hat in the store.
We can take a look at that. Yeah, great review. Also, Petra mentioned to us after we finished recording how she's an active listener and often recommends the podcast to her class.
Yeah, it's always
cool.
super cool to hear that from. It's one of the coolest responses I think that we can get when we ask someone if they'd be willing to come on the podcast is, sure, I'm a listener. And it's like, wow, that always blows my mind.
Yeah. So here's a cool story. I had a friend of the show, James, reach out. He said I could share this story. Just a quick note, Cameron. My daughter informed me today that she received an excellent grade on her final law paper. She argued in it that Canadian financial advisors should be held to a fiduciary standard. Proud dad moment for me. She listened to the Rational Reminder episode with Harold Geller twice as part of her research. So thanks. I guess she does listen to her dad at the dinner table after all. Anyway, I thought you might find that rewarding to hear.
That is cool.
So thanks for sharing that, James. And I had another LinkedIn story from another friend of the show. Great to connect. I've been a longtime listener and an occasional participant in the community. No other podcast, finance or otherwise, comes close to the quality of the Rational Reminder. Not only did the podcast help me realize that I was dissatisfied in my sales role and push me to make an internal job change into management, but also recognize that I had many years of human capital ahead of me, that I wanted to push myself into a graduate degree more than I wanted to strive for an early retirement. I'm now halfway through my MBA in Sustainable Innovation in university and have cited both the podcast and your guest work in multiple assignments, most notably an investment portfolio project where I brought in Alex Edmonds' Grow the Pie, Fama and French's 5-factor model, and Charlie Ellis's comment that only very few truly gifted individuals should engage in active management. Asking first-year MBA students to construct an actively managed ESG-aligned portfolio was, in my opinion, misguided, but at least I could give it a small cap value tilt. Much appreciation for the work that you, Ben, and Angelica put into the podcast. Count me in as one of the 3 listeners to the Aftershow and keep up the outstanding work. All the best.
It's funny that that's a thing. So someone said that to me in real life recently.
They're one
of the 3. There was a comment in the community that somebody left after episode 259. I wanted to just read that quickly as well. It was after we had talked about, you had done your 60-second recap of Brian Portnoy's episode, and I had said, like, we can't overstate how impactful that Brian was on us.
Yeah,
so somebody followed up saying, I'll read it. I was not aware the episode with Brian Portnoy was that influential on my life and well-being. During COVID-19 lockdown, I had a rough time being concerned about the future, having a 3-year-old kid, no savings, and going for a PhD. At that time, I first met the FIRE movement and was about to stop living, not literally, in order to save money and shut down that feeling of insecurity. It was your podcast and its additional focus on well-being and what makes a good life that helped me get back on track, inspired by the talks you had with guests, especially on non-financial matters, as well as your writing really helped me in a hard time. I do not have the words to tell you how much I appreciate your work and the effort you put into building this community. You make a difference for many people, I think. I know you did for me. Thank you so much. Be proud of this project. I thought that was pretty nice.
Very nice. Nice indeed. Thought I'd give a quick update on the 23 and 23 reading challenge. We haven't talked about that in a while. Of course, the challenge is still open. This is basically a group of us that have come together to try to nudge each other to read a bit more and try to meet your own reading objectives for the year. So you can visit rationalreminder.ca and click on the 23 and 23 reading challenge button. We're using the app called Beanstack, which is actually pretty cool. All the instructions are on the website, easy to set up. In there, I have now 399 friends on Beanstack, and I actually just logged my 31st book this year, and I only say that because that's just an atomic habit. Just daily, you chip away, 31 books already halfway through the year. In the past 30 days, I've logged 5 books. However, Scott is the leader now with 13 books in the past 30 days. Amanda, who is always there, has done 11. Andy comes in at 8 and Roman at 6. So there's some people cranking out some serious numbers here. Sandrine told me that there's 462 people in this year's challenge. 1,981 books have been read so far this year. 2,357 badges have been awarded, and 13 people have completed the challenge. So sign up. It's never too late. I think we'll run it again next year. Any comments about the community, Ben?
I did want to mention the community. We launched the ability to support the community financially a while ago, because the reality is, as cool as the Rational Reminder community is, as a business expense for PWL, because it's expensive, we pay almost $10,000 Canadian a year for the software that it runs on. As a business expense, it's like kind of hard to justify, because it's this global community of basically do-it-yourself investors mostly. And so anyway, we rolled out the option for people to support the community financially to take some of that bite off of PWL's plate. And a few people signed up, and we do have some people supporting. But I talked to somebody who's super engaged in the community and enjoys it, who this somehow came up in a conversation, and they mentioned that they didn't even know that there was an option to support it financially. So I just wanted to mention that there's a support button. I think it's kind of hard to see on mobile, but if you're on PC, there's a support the community button that you can click, and it's like relatively inexpensive. You can do like $3 a month Canadian, but it does help. It does help. It does help to justify keeping that thing up and running.
Yep. Good point. This fall, lots going on. You and I and Angelica will be at Future Proof in Southern California doing a live recording. Any advisors that are going to that? September 21st in Toronto, at the end of the day, we're going to be having a meetup. If you're interested in joining us, so we changed from the 20th to the 21st, so it will be the Thursday night. You can email info@rationalreminder.ca. Also, if there's any listeners in Salt Lake City, I'm going to be there in late September and have one evening that's free. So if there's any interest, we could set something up to get together. Also, we have a store. I haven't mentioned that in a long time. We have a merch store, so you can visit rationalreminder.ca and see the store button there. We sell everything pretty close to cost when you count shipping, and then you get a free pair of socks and koozie, and we have all kinds of stuff in stock. Our famous hoodies, apparently the supplier is no longer available with stock. So if you're thinking about getting a hoodie, you might want to grab one. And also there's just a few decks of Talking Sense cards left. Apparently those are being reimagined by the University of Chicago. So we shall see. So you want to talk about what led to our song. So anyways, for the three that are still left, might be down to two now, but Ben and I were invited to join Sean Maslick on his podcast, The Most Hated F Word, Fall in Love with Your Finances. So he invited us on to talk about the genesis of the podcast. So Sean's the host of this podcast, and he's a financial wellness advocate and podcaster, and he lives in Edmonton. So he invited us on, and as you can imagine, knowing a bit about us, it was rather uncomfortable, I think. Well, it was for me anyways, to talk about how this all happened and how we got together and how we started doing this and what are some of the mistakes we made. I did listen to the episode, and actually I think it came out, if you're interested, which there's might not be a lot of people interested in that backstory, but if you're interested in the backstory, I think it came out okay.
I did not listen to it for the reason that you said. It was uncomfortable to do, and it would be probably even more uncomfortable to listen to.
So the interesting thing is that while we were recording this conversation, Sean had a musician listening to the conversation, and through that wrote a song about the conversation and played us the song after the at the end of the recording. Like, it was crazy. Anyways, so the song was written by Root Hub, who's based in Hawaii. When he joined us on the podcast, looked like he was in the jungle of Hawaii somewhere with his guitar, right? And we're going to play the song at the outro here, but yeah, it was quite the experience. No comment, Van.
I'm nodding my head. Sorry, yeah, I guess people can't hear me nodding.
We now have an audio recording of the story of, goes back to how we met. I mean, it's
yeah, no, it's cool. I mean, it's cool to the extent that our lives should be documented. I guess that's a good thing. To the extent that.
Yeah, to the extent. All right, so here's the song from our recording of The Most Hated F Word with Sean Maslick, and this was written by Root Hub. Everybody, thanks for listening. Have a great week.
Rational Reminder.
clarity. Focus on the message and you unlock the key. Standing tall in integrity. Rational reminder of the marginal gains that add up when you invest every day. Oh, you can worm your way into